Hello everybody, welcome to the 9th episode of me learning how to trade using Forex. So we're currently doing the beginner course of how to trade on forex.com. Last time we finished looking through the using orders to open positions page, and we're currently on the take profits and stop losses lesson. So yeah, let's get started. Take profits and stop losses, as well as manually closing trades at their current price using market orders. You can use exit orders to set maximum levels of profit or loss. So, exit orders are used to stop to set maximum profit or loss. Exit orders are similar to entry orders, but instead of automatically opening position, use them to tell your broker or trading provider to close a trade when the market hits a specific level. Like with entry orders, you can use exit orders as either stop or limits. You'll often see limits referred to as take profit orders and stops as stop loss orders. This describes what each does. You use limits to lock in a set amount of profit, while stop closes a position if it goes a certain level of loss. Stop order, stop here, you bought it here. Limit order, limit here. Right, okay. Stop order. Order limits a certain amount of loss. Limit order. Limits a certain amount of profit. What are take profits? Take profit orders are exit orders that you can set to automatically close a position if it reaches a specified price that is better than the underlying market price. Take profit. Are exit orders that you can set to automatically close a position if it reaches a specified price that is better than the underlying market current prices. Automatic exit orders, which close a position if it reaches specified price that is better than the market price, right, than the underlying market price, the market's current price. They can help you to be disciplined with your trading strategy and not chase profits unnecessarily. Right, okay, so don't become greedy basically. Say for example you buy ABC index at 4250. You're planning on closing your trade if it hits 43,000, earning 50 points of profit. By setting a take profit 4,300, you're leaving in order to automatically close a position there. What are stop losses? Stop losses are exit orders that you can set to automatically close a position if it reaches a specified price that is worse than the underlying market's current price. So stop loss, is it losses? Stop losses orders are automatic exit orders which close a position if it reaches a specified price that is worse than the underlying market's price. Stop loss orders are an essential tool to help minimize your losses if your price moves against you. Let's continue our above example. You're aiming for 50 points of profit from buying ABC index, but are worried that the market may reverse. You only want to lose a maximum of 25 points from your trade, so you set a stop loss of 4225 to automatically close it and limit your losses. If you had shorted ABC index, then you would place your take profit 50 points below the current price at 4200 and your stop loss to 25 points above it at 4275. So reverse of what if you're buying it, for example. Types of stop loss. There are three main types of stop loss: standard, guaranteed, and trailing. Three types of stop loss: standard, guaranteed, trailing. Standard stops works in the way we described outlined above. Standard works the same as described above. You set a specific number of points from the current price of your trade, and if the market hits your specified level, the stop triggers and your provider closes your position. Guarantee stops. However, there is a chance that your position won't be closed at your precise chosen level. Markets can gap, which means that they move directly from one level to another without hitting any prices in between. If your asset's price gaps over your stop, then it will trigger there instead. If your asset's increasing your losses, guaranteed stops prevent this from happening. You pay a small premium, which ensures that your stop triggers at the exact level specified, even if the market gaps. Right, so pay a small premium to prevent market gap, which is when they from one level to another without hitting the price you set in between. Gap, guarantee stop. Trailing stops. Trailing stops follow your position if it earns your profit, helping protect profits without limiting them. If it earns your profit, like standard stops, you set trailing stops a specific number of points from the current price of your trade. But if the underlying market then moves in your direction, your trailing stop will move too. So it is still the same number of points below or above if you're short the current price. If the market then moves against you, then the stop will stay still. If the market continues to reverse, your stop will trigger, closing your position and protecting any profits you've made. Say you buy EUR/USD at 1.7045 with a trailing stop 30 pips away. If euro/dollar moves up to that 1.7080, then the trailing stop will move up to 1.0750. 30 pips. 30 pips, 1 pip is this. 30 would then be make a trailing stop, so 1.7075, right? 1.0. Why does that only move? So that moves up for 35, right? 35. $30 what? If the market then reverses $30, the trailing stop will stay put and trigger at 1.0. So trailing stops follow your position if it earns your profit, helping protect profits without limiting them. Like standard stops, you set a trailing stop a specific number of points from the current price of your trade. But if the underlying market then moves in your direction, your trailing stop will move too. So it's still the same number of points below or above if you're short the current price. If the market then moves against you, the stop will stay still. Oh, right, I see. So as long as you're making profit, the stop is going to be the same amount of, I guess, the same amount of points. There we go, the same number of points below or above if you're short of the current price. But then as soon as the market moves against you, the stop are going to stay still, so that whatever you made gets protected. Then if the market continues to reverse, your stop will trigger, close up zero, and protects any profit you made. So how do I explain this? Trailing stops. So similar to standard stops, you set set a points from the current trade price. Trailing stop will move positively will move with you. Will move same amount of points with you as long as you're profiting. However, as soon as loss occurs, if the current moves against the stop will stay still, then trigger. Other order types. Those are the most commonly used types of order, but there are a couple of others that can give you additional flexibility. One cancels other orders, enable you to place two orders at the same time. If one of these orders is then triggered, the other will automatically be cancelled. This is particularly useful when setting both a stop loss and take profit on an open position. Should one of these orders trigger, the other will be cancelled so it can't inadvertently open another trade. Most brokers, including Forex.com, automatically create stops and take profits as OCOs. You can also use OCOs when opening a new position. Say you think that Wall Street is in for a significant market move, but aren't sure whether it will be up or down. You could create stop entry 10 points above its current price and a limit entry 10 points below. Then if Wall Street moves 10 points in either direction, you'll open a trade automatically, and then the other order will be cancelled. If done orders. If done orders are essentially two-step orders, where the second order is only created once the first has been triggered. They're mostly used to create an entry order that has an exit order already attached. Then if your entry order is triggered, then a stop loss or take profit or both is automatically created too. If done allow you more flexibility and peace of mind. You don't have to monitor the markets 24 hours a day to protect your position, and can cover multiple outcomes to ensure the best result for your trade. Test your knowledge. You have a buy position on 123 Ltd shares with a standard stop at 156p. The stock climbs to 166p in this day, but the gap's overnight and opens again at 150p. What level will your stop trigger at? Oh, this is standard stop, so it's going to trigger 150p. What if it been a guarantee stop? What did you buy guarantee stop at? Was it 156? Yeah. You open another position of 123 out of each other, this time with a trailing stop, 5 points behind its current level. The market rises to 185p, but then steadily drops back. When does your 180, right? Yeah. Okay, so I think we've done this beginner course, how to trade course. Very good, very good. I think there's one more left in the beginner section. So, how to trade. Yep, this is all we've done, isn't it? Take profits. Yep, strategies and risks. Let's start on this one. So, strategies and risks. Strategies and risk. Strategies and risk. Delete those layouts below. Let's name it strategies and risk. There's the 09, 01, 2024. So, trading styles. Your approach to the markets has a significant impact on how you trade. It dictates which strategies you use, how you manage risk, and more. In this course, we're going to cover how to pick a strategy for trading a risk that suits you, but before we get to that, you'll need to decide your trading style. What's your trading style? Every trader is unique and will have their own trading style. The chief factor in deciding yours is how much you want to trade and how long you want to keep each position open. Okay. Main factor to decide trading style. How much you want to trade. How long? Position. Long-term traders, for example, tend to only take a few positions each quarter. They'll keep them open for months at a time, looking to earn 10% or more profit from each. Day traders, meanwhile, are the opposite. They may take multiple positions each day, keeping them open for minutes or hours. Using leverage, they aim to profit from relatively minor market moves. There are also short and medium-term traders, who fall somewhere in between. Or you might decide to employ a mix of a few different styles. It's all about finding an approach that suits you. Day trading, short term, medium term, long term. Trades multiple positions during the day, trades few throughout the week, trades in a month, trade only a few through a year. Typical trades last between minutes and hours, 1 day, 1 week, 2 weeks to a month, 1 and 2 quarters. Looks to profit from small market moves, 1 to 5%, 5 to 10%, 10% more. Basis trades on technical levels and market news. Basis trades on both technical levels and fundamental analysis. Both technical level and fundamental analysis. So I think this is going to be the biggest determination of whether I want to go into day trading, short-term trading, or medium-term trading / long-term trading. Fundamental analysis. Types of trades. As well as determining your strategy, your trading style will detect which types of trades you employ. With traditional investing, you can only open one type of trade, buying an asset over the medium to long term, and holding it in the hope that it earns you a profit. With leveraged products like CFDs, there are different types to suit different styles. Here we're going to cover two main types. Standard CFDs are ideal for shorter term opportunities, while forwards may be better for longer ones. What are daily CFDs? Daily CFDs are trades that are intended to be kept open for short periods, from less than a day to a couple of weeks. They have a tighter spreads than forwards, but will incur an overnight finance charge if held open after market closes. Daily CFDs have no expiry. What are forwards? Forwards are meant for longer positions, from a few weeks to several months. With forwards, all overnight financing charges are incorporated into the spread, so the spread is wider, but you don't pay any overnight financing. With Forex.com, you can choose between forwards that expire in a given month, monthly forwards, or future quarterly forwards. Differences at a glance. CFDs, tighter spread, no expiry dates, incurs a finance charge for positions held overnight. Forwards, wider spread, fixed monthly, quarterly, expiry date, no overnight financing charge, as cost is contained within the price. Okay. Longer term strategies. If you're looking to generate returns from a few positions that deliver high profits, then you're probably a medium or long term trader. There are lots of strategies that suit long term traders, but here we're going to focus on two of the most common: position trading and swing trading. What is position trading? Position trading is a strategy that involves opening a low number of trades with the aim of delivering healthy gains over the long term. Position trading, so opening a low trades in the forms the basis of traditional investing, but it is used by many leverage traders too. Name: position trading, title frame, medium to long term. Find the trades using mostly fundamental analysis. Requires patience, cool temperament. Fundamental analysis. A common trade in this strategy would be to buy shares in a company that you believe is going to grow over the coming months and years. You wouldn't realize any profits from the opportunities for a long time and might target a return of 10% or more. Hunting for such wide profit margins can mean taking on more risk from each trade. Leverage traders, of course, can short markets as part of their position strategy, basically selling shares instead, and then buying it back at a cheaper price. To do so, though, you need to find an asset that you believe is going to depreciate over long periods. If you're using leverage as part of your position trading strategy, then you might consider using quarterly forward trades. That way you won't have to pay overnight financing charges. You will also need to ensure that you have sufficient margin in your account, so the deposit, remember, to cover any adverse movements to your chosen market. When you're keeping trades open for such long periods, some negative price action is likely. How do position traders find opportunities? If you're considering position trading, you'll need to identify trades that offer a large amount of potential upside over long periods. Most position traders will do this using fundamental analysis, examining the facts and figures surrounding each market to try and find underpriced assets. We'll cover this in more detail in the fundamental analysis course. Even when your trade is a success, it may take some time for those assets to return a profit, and you may see some turbulence along the way. For this reason, position traders need to have a cool temperament and a lot of patience. Position versus trend trading. One popular alternative to position trading is trend trading. Instead of looking for undervalued assets, trend traders try to identify significant market moves as they form, then ride the resulting trend for as long as it lasts. Instead of focusing on fundamentals, trend trading uses technical analysis. Jesus, these wording, to spot the higher highs or lower lows that indicate a new trend. You can look for a short-term trend as well as long-term opportunities. Some day traders even use this strategy. It isn't restricted to any single style. What is swing trading? Swing trading is a strategy that looks to profit from the oscillations that occur within wider market moves. So swing trading. Looks to profit from the oscillations that occur within wider market moves. Swing traders will usually trade more frequently than position traders, staying in each market for shorter periods from a couple of days up to several weeks. From the oscillations that occur within wider market moves, swing trading medium term, mostly technical analysis, requires knowledge of indicators. When swing trading, you're aiming to profit from a small part of a longer trend within a given market. Even within strong bull or bear moves, most assets see substantial price action against the prevalent trend. Swing traders attempt to use that price action to earn a return. Say that the FTSE 100 goes on a bull run from 6,000 to 6,400 over several quarters. On the chart, this move would almost never look like a straight line. Indeed, there may be days or even weeks of negative action as buyers and sellers vie for control. Swing traders look to trade these smaller market moves. They try to buy or sell a market at the beginning of a mini trend or a swing and keep their position open until it ends. How do swing traders find opportunities? Like trend trading, swing traders usually involves using technical indicators to decide when to enter and exit positions. A common technique is to identify areas of support and resistance, which typically see reversals in price direction. We'll cover this in more detail in the technical analysis course. Areas of support and resistance. You find an underpriced stock using fundamental analysis. Buy and hold a trade for several quarters. You're position trading. You see that the DAX is beginning a bear run. You short the market, holding your trade until the move ends. You're trend, aren't you? During the FTSE 100's bear run, you buy the index, take advantage of the short reversal. Your swing. Very good. Day trading. Day trading is a popular way to speculate on financial markets. Here we look at what day trading is and which markets you can trade on. on which market you can day trade on, plus 2 handy strategies. What is day trading? Day trading is an approach to the markets that involves opening and closing positions within a single day. So, day trading. Involves opening and closing positions within a single day. How much you trade is up to you. You could stick to once per session or less, or open positions frequently as you spot new opportunities. Because trades are kept open for such short periods, day traders look to profit from small price fluctuations in very liquid markets. Day trading is short term. Technical analysis requires time, good nerves. Okay, time, good nerves. One major advantage of day trading is that it removes the risk and costs associated with keeping a trade open beyond the market close. Day traders don't have to worry about prices gapping overnight and don't have to pay financing charges on their positions. However, it requires a lot of time to devote to the markets. Although many day traders use mobile apps, stops take profits are more to avoid sitting at a screen for many hours each session. Day trading is fast paced, so it requires proficiency and skill to analyze the market and make rapid decisions. This can be very stressful and certainly not suited for everyone. Which market can you day trade? Market liquidity is important to day traders because they need to be able to move in and out of positions quickly. Any delay to the trade can make the difference between a profit or loss. So while you can day trade at any market, the most popular ones usually are Forex pairs and indices. Forex pairs and indices. So this is the foreign exchange, foreign currency exchange, and a group of stocks or index. One other key factor in choosing markets to trade is costs. As day traders look to take advantage of relatively small price moves, the cost to open each position can have a significant impact on this result. Say that you're looking to earn a profit from a 10-point move in a market. Paying a 0.5 spread on EUR/USD means you can keep 9.5 points as a return. Trading stocks where you have to pay a commission charge means your gain is far lower. Finding day trades. Because of the time-intensive nature of day trading, most participants aren't able to pore over fundamental data when choosing which opportunity to pursue. Instead, they tend to rely heavily on technical analysis. Ignoring economic data entirely can be treacherous. However, major releases will often have a significant impact on market prices, so you need to be aware of what might be driving volatility in any given session. So don't ignore economic data. Day trading strategies. Any strategy that enables you to capture short-term profits can be used when day trading, but here we're going to focus on 2 popular options: trend trading and scalping. Trend trading. As we covered in previous lesson, this strategy can work over both the long and short term. When day trading, you're looking to take advantage of the price action over a single day, either by capturing a small portion of a large trend or by finding mini trends. Name: trend trading, any, mostly technical analysis, lots of time, good nerves. There are lots of different ways to identify trends. For example, you could look at the price action to try and spot higher highs and lower lows. You could use indicators, trend lines, moving averages, and more. Scalping. Scalping is a very short-term strategy that involves taking lots of small profits each day. Scalpers will open and close multiple positions each session, with some trading every few minutes or even seconds as they hunt for opportunities. Lots of time, good nerves, mostly technical analysis. When scalping, you're aiming to earn small profits on most of your trades, targeting a higher win rate than day or position trading. Once a market has moved a little in your favour, you exit it to realise a profit. If a market moves even slightly against you, you immediately close the trade and take a small loss. a little bit. Scalping is one of the most intense forms of day trading. It requires even more time and a disciplined approach to avoid letting profits or losses run. After all, when margins are this thin, a single large loss could wipe out the gains from multiple successful positions. True. Whichever strategy you decide to use, solid risk management is essential when day trading. Day traders often use market structures to set up stop losses, for example by identifying support and resistance levels or using moving averages. Summary: day trading is the opening and closing for trade or multiple trades before the market closes. Day traders often trade Forex and indices as they have high liquidity and tighter spreads. A sound risk management strategy is essential to prevent wiping profits out. While this style of trading avoids the potential for overnight movements or gapping, it is fast-paced, time-consuming, and can be stressful. What type of trade would a day trader typically use? CFDs. Which market is more popular among day traders? Or you are USD JPY, right? Yeah. Alright, risk management. Risk is an essential part of day-to-day trading. Without risking capital, you can't achieve any returns. But traders today have a suite of tools to help them control risks so they manage their positions. What is risk in trading? In trading, risk is the potential that your return from a trade may be lower than you expected. Risk is the potential that could be because you had to close it beneath your profit target, or it could mean losing all the capital you spent on the position. No trader gets every decision right, so it's essential to develop a comprehensive plan for managing risk within your trading, especially when using leverage, which will amplify losses as well as profits. There are three main types of risk to be aware of. Three main types of risk to be aware of. Market risk, liquidity risk, systemic risk. Market risk. Market risk is a possibility that your trades will earn less than expected due to adverse movements in market prices. That's due to the adverse movement in market prices. It is the most common type of risk and the one that most traders do most work to mitigate. One important step to controlling market risk is to understand the unique factors that will drive prices on the asset you trade. To control this, understand the unique drive prices on the If you're buying stocks, for example, then you should learn the effect that interest rates, forex prices and more might have on the companies you're investing in. Some might be obvious, but others can be more obscure, so even if you think you know your chosen market well, it's always worth using stop losses and take profits. Liquidity risk. Liquidity risk arises when you can't exit a trade as quickly as you want to. Exit trade quickly. This may hurt your profits or leading to a loss from a position. Say that you own shares in X, Y, Z and Co, a relatively unknown firm. The trade isn't delivering the returns you expected, so you want to exit the market, but you can't find anyone who wants to purchase your stock. You may have to sell your shares for a loss to get them off of your hands. Liquidity risk is less of an issue when you're trading CFDs or Forex with a market maker such as Forex.com. You never own the asset in your account, so you don't need to find a counterparty for each position. Systemic risk. Final risk is there's first the chance that an issue with the wider financial system will hurt your bottom line. The chance. A classic example of systemic risk is a global market crash. Here, stocks and indices around the world tumble, with subsequent impacts on other assets. Unlike market risk, the problems are widespread and systemic. Systemic risk can be tricky to mitigate against, but one common method is diversification. Diversify your trades across multiple can help protect you if your crash arises. However, you'll need to ensure that you research each market properly. Developing a risk management plan. The key to controlling each type of risk you encounter is to develop a risk management plan. A comprehensive plan will cover your exit strategy, position sizing, and how you pick opportunities. Exit strategy. The key to controlling each type of risk you encounter is to develop a risk management plan. Risk. So, exit strategy. Before you enter any position, you should know exactly where your point of pain resides. Exit strategy. Before you enter any position, exit. Before you enter any position, you should know exactly where your point of pain resides, the maximum loss you want and can afford to risk from a single position. Before entering, you should exactly where consistently allowing losing trades to go beyond this point is a recipe for failure. So decide the maximum you can lose from any given trade and stay disciplined about exiting any markets if it hits that level. A common mistake among traders is to hold on to losing trades in the hope that they will return around. A good risk management plan will help you avoid this potential hazard. Consider entering stops on all your trades. Position sizing. Another habit of many pro traders involves position sizing, which is where you decide how much capital to allocate to each opportunity ahead of time. Before you open your first live trade, it's a good idea to determine proper position size according to the size of your account. This can help you control and quantify your risk. Obviously, a £10,000 account may use different position size rather than a one with £1,000,000, but however much you're trading with, you can go a long way to avoid large losses by paying attention to the size of your positions. Before opening your first live trade, decide how much capital to allocate to each opportunity. According to the size of your account. Finding trades. Instead of rushing into new positions, opportunities should be weighted and considered carefully. This means creating a detailed trading plan as part of your present preparations and sticking to it. Create a detailed trading plan and sticking to it. Try to avoid entering into any trades randomly or haphazardly, based on emotions of excitement, greed or fear. The fact that a market is rapidly moving one direction or another may not constitute a rational reason for getting into trade. We'll cover creating a trading plan in more detail in the Techniques of Successful Traders course. Detailed trading plan and sticking to it. Instead of rushing into any trades randomly. 5 key things to remember. Trade with prevailing trends. Consider taking the path of least resistance and go with the flow of the current market. Establish a detailed strategy for entering and exiting trades. Detailed strategy defines parameters for getting in and out of the trades, so there's no ambiguity. Watch your downside risk and be prepared to act decisively. Make sure that you're disciplined enough in preserving your account so that you can live to trade another day. Trade with reason, not emotion. Human emotions, excitement, greed, fear don't always lend themselves to successful trading. Avoid trading right around scheduled news events. Markets can be more volatile around news events, meaning prices may move drastically within short periods. You have test your knowledge. You have an open long position on your US Treasuries which has hit your profit target, but you are unable to close your trade because you can't find a buyer. This is an example of liquidity. The Federal Reserve lowers interest rates, which sends the USD down and reversely affects your open short USD JPY position. This is an example of a market risk. A worldwide pandemic hurts stocks, causing a long FTSE 100 position to fall. This is an example of a systemic risk. Very nice. And on that note, we're going to end the video here. 48 minutes, yeah, that's good. So in the next video we're going to cover using orders to manage risks. Thank you for watching. See you then.